Ladies and gentlemen, it's a pleasure and honor for me to welcome all of you to our online seminar. I'm Sergey Lalin, founder and CEO of Cbonds. As you may know, Cbonds is a data provider. We provide data on financial markets with the main focus on bond market, and also Cbonds is a conference house. We've started this activity with online seminars from the beginning of pandemic, from April this year, when we felt a need from our client for such a format. At that time, markets were extremely turbulent, with bond yields going up sharply and bond prices going down sharply, and investors looked around, what should I do in the middle of this nightmare? Since that, things have changed rapidly, and now it's totally different, and we see that on many markets, the yields are on the historically low levels, which means, from the one hand, that investors have very nice historical returns, but they have to reinvest in less and less and less yielding bonds. Obviously, it creates more demand for risky assets, including emerging market bonds. When government bonds are in many countries, in developed countries, are in a negative yield area, of course, investors tend to explore other opportunities, including, again, emerging markets. And for today's event, we've decided to make it region-specific, so we will not focus on global markets. We will focus on markets Middle East and Asia. And we have two prominent experts who are to join us today. The one is Mr. Sri Rudra Narayan Kar. He is CEO of a company called Financial Benchmarks, which is a company providing benchmark calculation for bond market and for money market in India. And our second expert is Stanley Tsai from Penyan Credit Rating from Hong Kong. It's a rating agency covering bond market in China and Asia. And then we will have a short presentation from my colleague, Shri Vijay Kakirde, who will show how you can use bonds as an investor to look at bond data, to make bond choice, to compare bonds, etc., etc., etc. So let's start, and I will now pass the floor to Shri Vijay Kakirde, who will be moderating our seminar today. And very nice feature of online seminars is that you can easily put your questions to our experts. So there is a chat that you may see, so just type your questions there, and we will do our best to ask our experts to answer all of your questions. So thank you for your attention, and now I will pass the floor to my colleague, Shri Vijay Kakirde.
Good morning and good day, everyone. Thank you very much, Sergey. So as Sergey already mentioned, I'll give you a brief agenda of what we are having today. So first speaker is Mr. Rudra Narayan Kar. He'll be giving us an overview of India microeconomics. He has 33 years served for RBI in various regulation capacities as supervision and market clusters. He retired in 2017 and joined Financial Benchmarks India as CEO. He has experience in forex reserve management, capital management. He's involved in committees and work groups set up by RBI and SEBI. He has chaired work group of CDS. He has served nominee director of banks of Bank of Hyderabad and Syndicate Bank. So I request now Mr. Rudra Kar to join in and give us a brief overview of the India microeconomics. Thank you.
Good morning, everybody, ladies and gentlemen. Can you hear me?
Yes, yes.
Yeah. Greetings from Mumbai. So, is a background. The COVID-19 possibly is at its peak, and the numbers are regularly, continuously rising. So, uh, I would give a brief overview of the macroeconomic indicators. Since the topic is only for 10 minutes, I'll give an overview of the indicators and draw some inferences with regard to the extreme situation which we are passing through. If you look at the real GDP growth between 1819 and 1920, it has substantially decelerated. And per capita real GDP growth also has moved downwards from 5.1% in 1819 to 3.1% in 1920. Export growth has decelerated from 12.3% in 1819 to a negative territory of minus 3.6%. Import growth has decelerated more from 8.6% to minus 6.8%. The CPI, the All India Consumer Price Index, which the Reserve Bank of India targets as its monetary policy for its monetary policy plan, has been also in the decline from March 20 at 5.84 to March 2019 at 2.86. Inflation wholesale price index has moved down from 4.3% to 1.7%. Coming to the fiscal situation in India, the government of India's fiscal deficit has gone up a little bit from 3.4% in 1819 to 3.8% in 1920. And if you combine with the state's borrowings or state's fiscal deficit, so obviously it has moved upward from 5.7% to 5.9%. This has happened because during this period, there has been a moderation or acceleration in the economic activities and forcing the government to spend more or expand its activities more. So now this slide would give you a feel of the growth of different industries in the Indian economy, which contributes majorly to its GDP. The major sector where the drastic sharp fall has been seen is basically mining, which has gone from minus 5.8, gone down in 18, gone down at minus 5.8%. It has shown some growth of 3.1%. But other than mining and agriculture, of course, agriculture, last year there was a good monsoon, and this year we are also predicting a good monsoon. So we pin our hopes on a good agriculture harvest this year too. Rest of the parameters are not looking as good as you would presume. Yeah. This I will skip. I will only talk about the gross fixed capital formation as a percentage of GDP. In 2020, it has sharply fallen from 31.9% to 21.8% this year. External sector, I have talked about the decline in exports and decline in imports. Obviously, this has the impact on the current account balance. The current account balance has, it was at minus 57.3 billion in 1819, and it has come down to minus 24.7 billion. It is with obviously with the deceleration in the economic activity, the current account balance has improved. And in 2021, in the first quarter, you have a current account surplus of 0.5 billion, although India is generally a current account deficit country. In terms of capital account has seen a hefty good growth from 53.9 billion in 1819 to 84.2 billion in 1920. In case of FDI has also seen good growth, and foreign exchange reserve has commensurately grown between 1819 to 1920. As on July 3, the reserve stood at 13 billion, 0.25 billion US dollar. I'll make some observations about the real economy. The growth actually slowed down during the period of 1920, much before the COVID-19. But yes, after the COVID-19 pandemic, it has worsened. The situation has worsened. Manufacturing sector experienced a massive decline, but agricultural sector and, as I explained, and government sector, these are the two areas of growth, main source of growth. Construction, which is generally labor intensive in India, has suffered badly and possibly continues to bleed. The main driver of growth was consumption in expenditures. External sector balance, as I had shown earlier, has improved because of huge improvement in current account balance, and of course 33% jump in the FDI flow. Coming to the Indian economy financial sector, yeah, I would just like to indicate the status of bank credit. While the bank credit to the government continues at 11.8, it's at 11.8%, or bank credit to the commercial sector, which is the which moves the wheel of the economy, is growth is only at 6.3%, and growth of bank credit to the micro and small industries 1.7%. To medium industries is minus 0.7%, and to large industries only 0.6%. It shows that the growth of the credit has not been very robust. So the next slide, it says bank credit moderation across all bank groups. The one indicator of the soundness of the banks is the capital to risk-weighted assets ratio, CRAR. In September, it was at 15%. In March, it is 14.8% in March 2020. And it has seen slight improvement from March 2020. The gross GNPA, the gross non-performing assets of the banking system, it has shown improvement from 9.3% in September to March 2020 at 8.5%. Provision coverage ratio also has improved, and improvement in asset quality and profitability. Coming to the RBI policy stance, the fact that there is a moderation in the economy, although the inflation has risen in some parts of 1920, there has been a continuous accommodative monetary policy stance by the Reserve Bank of India. In April, the policy repo rate, which is the lending rate of the Reserve Bank to the banking system, was at 6%, and it fell to 5.15% by August 2019, which is almost 60 basis points lower, and then to 5.15 in October. Since then, keeping in view the inflation target, it I think continued its policy stance till February. And after February 2020, when the ramifications of the COVID-19 pandemic unfolded, RBI went into the monetary policy action, and it reduced its policy rate from 5.15 in February to 4% in May 2020, which is roughly 115 basis points lower. And these two rates were reduced not in the usual monetary policy meeting made outside the scheduled policy meeting. This basically shows the policy repo rate, and the movement of the weighted average call rate. This is an indicator how the money market has moved. It has been generally stable, and it has moved in sync with the monetary policy rate. 10-year G-Sec, which was around 7.3%, sometimes in the April 2019, has moved to almost to 5.80%, maybe in refresh study. Okay, this movement in exchange rate, you can see this. Obviously, the exchange rate of rupee against the US dollar has depreciated during this period, and possibly I would say in line with other emerging market economies. The foreign portfolio investment flow, which generally used to be very robust for India, it has decelerated during the period of last 6 months. Yeah, now I would summarize it. So macroeconomic impact of the pandemic is turning to be more severe than initially anticipated. This is basically the MPC stance of May 20, the MPC Monetary Policy Committee stance of RBI on May 22 May. The demand and supply side disruptions are very evident. Diminished consumer confidence. So as of now, no growth estimate by RBI or by the Government of India. IMF June 20 World Economic Outlook Forecast. It says for FY21, the economy may shrink by 4.5%. And I think ADB also has projected a negative, has given a negative growth projection. On yesterday, the Governor of the Reserve Bank of India was speaking somewhere else in some forum, and he has indicated that the GDP growth may be in the negative territory. Although he has not quantified what would be the rate of growth, likely rate of growth, but he has hinted that the rate may be in the negative territory. Yeah. To fight the COVID-19 impact, the government and Reserve Bank has initiated measures. Reserve Bank initiated monetary measures like introducing long-term repo, targeted long-term repo, liquidity injection by open market operations and sectoral open market operations, which is roughly 4.5% of the country's GDP. Government of India also has supported with package which is maybe equivalent to 10% of the country's GDP. And the measures are by way of sovereign guarantee for credit, direct fiscal expenditures, and long-term structural policy reforms. The target area have been rural employment, infrastructure, support to medium, small, marginal enterprises, MSMEs, enabling business environment, and relief package for vulnerable section of the society. Yeah. So this is the last of my presentation. As I said, that there is a problem the country is tackling, and the end of COVID-19 pandemic is not yet in sight. The government and RBI are continuously on guard, looking at what more can be done to stabilize the economy. Certain experts have said that there are certain green shoots showing up, but it needs to be buttressed and sustained on a long-term basis. But the banking system is possibly resilient. Of course, it would all depend on what kind of future NPS emerge once this moratorium period is over, and what kind of stimulus package or what kind of further initiative is initiated by the government of India to stabilize the economy. Thank you very much. Over to you.
Yes, thank you very much, Mr. Carr, for a brief overview. Dear participants, attendees, if you have any questions to Mr. Carr, this is the right time. We'll wait for a minute because this is the chance to get answers to your questions which you have. So I guess it was a very good presentation because we had you gave us an idea on the sector-wise growth as well as the post-COVID aftermath, what would happen. So thank you very much. I guess we don't have any questions, so we'll move ahead with the next session with Mr. Stanley. Thank you very much again, Mr. Carr.
Thank you very much. Thank you very much for allowing me to speak on your online seminar. Looking forward to interacting with you again. Thank you very much.
Thank you. Thank you. So now we will move to the next session of our seminar, that is will be presented by speaker Mr. Stanley Sai. He is MD of Financial Institution Rating at Finian Credit Rating. He has 15 years of experience as a financial analyst. He's responsible for covering financial institution sector, banks, asset manager at Finian International. Stanley started his career as director of insurance research at Fitch Ratings. He was involved in IPO of AIA and China Reassurance Corporation, of 20 and 2 billion USD respectively. He has advised more than 200 long only hedge funds. So I request Stanley to join in and take the floor and give us a brief on credit profile of banking sector post COVID-19.
Well, thank you very much for your kind introduction, and thank you, Rudra, for the fantastic presentation on India. So it's been a challenging environment, as you all know. And one question that we get asked a lot is, with interest rates so low or even negative, where do we find yields? One obvious destination is China. So we've been seeing 20, 30 billion US dollars of inflows into the onshore bond market in the last few months. The problem, though, as we see it, is the money's been going into mainly sovereign bonds or the policy banks bonds. The reason perhaps maybe do international investors not understand Chinese credits, or is there something else? And today, I think what we want to do is to answer that question as far as, okay, if you don't want to invest in the corporate credits, what about the negotiated certificates of deposits of the banks? What about the subordinated debt of the banks? What about the AT1? So today, we hope to be able to answer that question. So if you look at this chart, right, so on the x-axis, we have 5-year average return on equity. On the y-axis, we have the 5-year average CET1 ratio. So where you would want to be is at the upper right corner. So what I think this chart is intended to show is basically the trade-off between shareholders and bondholders. On the one hand, management would like to maximize their return on equity. On the other hand, they want to be able to pay their creditors as well. So if you look at the more sophisticated financial institutions in the world, they're really not looking to maximize their credit ratings. They're looking to optimize their credit ratings. So basically, I think this chart, what it shows is how management thinks about the trade-off between shareholders and bondholder interests. And if you look at this chart, right, for those of you who follow financial institutions globally, you would think maybe at the upper right-hand corner, maybe it's a JP Morgan, maybe it's a Citibank, but then it's not. So basically, these are the 6 biggest government-owned banks in China. So at the upper right-hand corner, you've got China Construction Bank, which on average over the past 5 years have been making a 15% return on equity, which I think is more than enough to cover their cost of equity. And the CET1 ratio has been about 13%, which is comfortably above what they have to keep, even as a global systemically important financial institution. At the bottom, you've got Postal Savings Bank, which has been making, in the lower teens, 9% CET1. It's not bad, right? But if you look at the other group of banks in China, so these are what they call the joint stock banks. So these are technically not the nationally owned banks. And if you look at the x-axis, you've got China Merchants Bank. So you've got a bank that's been making 16, 17% return on equity consistently over the last 5 years, or even the last 10 years or 15 years for that matter. And they've been maintaining a CET1 ratio in between 11, 12%, which is not bad. But what about the other banks globally, right? So there you've got JP Morgan that's been doing ROEs of between 10 to 15% in the last 5 years, CET1 above 12%. not bad. But look at what their stock prices have done, right? And you look at Citi and HSBC, right? They've been doing about 5%, which is not nearly enough, I think, to cover the cost of equity. And that's one of the reasons that they've been struggling. And I think one of the lessons that we learned from this chart is the American banks have done a lot better than the European banks since the financial crisis for various reasons. For example, if you look at Deutsche, so you've got this bank which is doing negative 5% ROE consistently, right? And that just goes on to show you how difficult the environment it is compared to what we're seeing in Asia. And one of the things that we look at very intensely as a credit rating agency is how important these banks are on a systemic basis, right? So if you look at this table, the FSB publishes a list of all the global systemically important banks on an annual basis. So every November, they publish this list, and the 4 largest banks in China are basically the 4 largest banks in the whole world. ICBC, Bank of China, CCB, ABC. And although the asset size may be a lot bigger than a JP Morgan or HSBC or Citigroup, they are not nearly as complex as these international institutions. And the way we look at the support that governments give to these institutions is basically in line with what Basel III says, right? So you look at the size, which is based on the assets. You look at the interconnectedness, which is based on their interbank balances. You look at how complex they are in terms of what assets they hold. And then you look at the substitutability, which is basically the trustee custodian roles that they play, right? And that, I think, matters a lot to fixed income investors in the FI space, because support matters a lot in this particular sector. And the next chart basically shows where are we now in terms of bankruptcies, bank bankruptcies in the whole world. So if you look at the US, right, so we've seen 2 bank failures since COVID-19. And obviously, if you look at this chart, it's skewed towards the financial crisis. So in 2008, 2009, you had the Lehman Brothers, you had the Bear Stearns. But then consistently, we've been seeing like bankruptcies in the range of like 5 to 10 banks a year. And in China, so far, we've seen 3. So that's just to put things into context. Now, the 3 banks, the 2 banks that have failed in the US are relatively small, right? So one of them is the First State Bank, which has 152 million US dollars in assets. The other one is Ericsson State Bank, which has about 95 million US dollars in assets. So these are relatively small banks, but does that mean that we are not concerned about the US banking industry? Of course not. We are very worried. Commercial mortgages, we think at least 1.5 trillion US dollars are in default. We are worried about residential mortgages. We are worried about credit cards. We are worried about student loans. And I think there's also, with the United States, there's also a political dimension to it. So what happens after the elections this year will matter a lot to what to how the banks will perform credit-wise. Now, Europe is a little bit different. They have been struggling, like I said before, well before COVID-19. So after the financial crisis, they had never really recovered to the profitability levels that they were running at before 2008. And fundamentally, you have to realize the European economy has a much stronger reliance on banks than in the US. 2/3 of European companies get their credit in the form of bank loans. whereas with the American firms, they get less than 1/3 directly from the banks, and the rest are basically bonds and equities. And also, like I said at the beginning, the negative interest rate or the low interest rate environment is a major risk to even the largest banks, because when you're running at the risk-free rate 0% or negative 0.1%, how do you make a margin on your loans, right? So we are running the risk that we're going to be looking at a Japanese bank type of scenario if they don't recover in the next 2-3 years. And I think ultimately the last point that I would like to make for Europe is that there's likely going to be consolidation. Are we going to see mega M&As? Perhaps. But then on a national basis, in Germany, for example, or in Spain, for example, we're going to see a lot more M&As going forward. So what about in China? So this chart shows it's something that we've done, and it's something that we're going to continue to do. It's what we call the S-risk model. It's basically an equity market implied view of what the potential capital shortfall is going to be for the Chinese banks. And when we last updated it, it's at about 5 trillion RMB. So basically, if your stock trades at below book value, what the market is telling you is, I don't believe what's on your book, right? You can work out the forward-looking net interest margin. You can look at the forward-looking cost-to-income ratio. What's left, basically, after the pre-provision profit is basically your non-performing loans. And what the market, at least the equity market, is telling us, they're very concerned about non-performing loans in China. And what does that mean in terms of percentages? So what 5 trillion for the banks in our sample basically means the NPLs are closer to 10% than 1.8% that they are reporting. So there's a huge gap between what they're reporting now and what the market believes. And where do we think the risks lie, right? So if you look at the Chinese financial system, so at the very top, you've got the large commercial banks, meaning ICBC, CCB, ABC, BOC, plus the Postal Bank and Bank of Communications. And then you've got about 15 joint stock banks, and you've got the policy banks, you've got the rural commercial banks, and then you've got the city commercial banks. So where we think the risks lie, and I think since the onset of COVID-19, we've done extensive research across all the corporate sectors that we cover. And the consistent message that I've been getting is there's going to be a diversion of credit risks. And I think it's going to be the same for the financial sector as well. So the bigger banks are going to get better. The smaller banks are going to get weaker. And it's going to happen for the next 2-3 years. And one other thing I want to mention in this chart, if you look at the gray shaded area, the trust company AUM and the bank off-balance sheet WMPs, so these basically form what we would call the shadow banking system. So shadow banking in and of itself is not necessarily a bad thing, right? So who invented shadow banking? The US did. So it's the structured finance stuff that they're doing still right now, right? So what worries us with the Chinese market is not necessarily because it's off the books of the banks, but it's because of the lack of regulations, or because of the fact that the assets themselves, right, underlying these wealth management products are not necessarily funding the real economy. If they are essentially a leverage investment vehicle back into the capital markets, then we would get worried. So what's going on now, right? So the Chinese regulators realized this 4 or 5 years ago. So after the massive Chinese version of QE in 2008, the banks the financial institutions, the trust companies, the securities company started doing these financial innovation type vehicles. They've clamped down on this a lot. I think the initial deadline is for them to be able to solve basically the whole problem by the end of this year. But because of COVID-19, I think that's going to be pushed back for another 12 to 24 months. So what are the policymakers doing to help the economy, right? So it's similar to what Rudra said. So we need accommodative monetary policy. Are we at the point where the central bank is printing money like they were in 2008? We are not nearly close to that. But that they are keeping a neutral to accommodative monetary policy, which I think is going to help especially the smaller banks. So we're going to see lower lending rates. This year, we've seen a lot of loan forbearances and grace periods, and it's not specific to the Chinese market either. If you look at the U.S. Banking sector, one of the problems that they have is they are basically flying blind into the next 12 to 18 months. With the loan forbearances, they don't know whether the customers who are not paying, whether they cannot pay or they're taking advantage of the loan forbearance periods. So we're seeing some of that in China as well. And obviously we're going to, like in India, we're going to see a policy orientation towards small to medium enterprises. And we're going to see more somewhat relaxed policies towards the banking sector. And what do investors care about, right? So number one, obviously, is what's the impact of lower lending rates or lower interest rates on bank profitability? So I think this chart is interesting in the sense that if you look at the end of 2010, early 2011, there was a spike in the intermarket rates. And that's when we saw about 2 to 3 rural commercial banks default in the interbank market. And since then, I think the central bank has been providing enough liquidity just so that even the smaller banks can repay in the interbank market. Again, are we going to see a lot more liquidity? I don't think so. They are very worried about asset prices still. So interbank rates, I think, for the most part, in the next 2 years are going to stay at this level. But lending rate, I think, still has room to go down. So in the middle of 2019, they changed from their initial base lending rate to the loan prime rate, and since then, basically the benchmark rate has come down by about 50 basis points, and I think there's room for that to go down further. But is that going to fall below 3.5% in the next 12 months? I think the likelihood is going to be fairly low. So that's going to affect bank profitability, obviously, right? So they're getting less from their loans, but at the same time, they're competing for deposits. So overall, what's the impact on the bank's profitability? For the whole sector, I think it's going to be in the order of maybe 20, 30 basis points for this year. So it's not catastrophic, and it's going to be a profit and loss problem rather than a balance sheet problem. What I think is going to be a balance sheet problem, though, is with the loan forbearances and industry support, right? So what I've been hearing from my colleagues since the beginning of COVID-19 is we think our companies, the companies that we cover, are going to do okay because policymakers are going to support them, right? And I go, something's got to give. Who's providing the support, right? It's either the government or the banks. If you look at the banks, the peculiar feature about Chinese banks, I think, is their special mention loans, right? So if you look at ICBC in this chart, for example, their reported NPL is 1.5% perhaps, but then the special mention loans altogether, or what we would call problem loans, is about 4%. And if you look at the chart below that, the loan coverage ratio, which basically means how much provision they've set aside against these non-performing loans, they've set up aside maybe 3%. So they're still short about 1%. So that goes back to our initial analysis about what the equity market implied non-performing loans is. Obviously, there are outperformers. If you look at China Merchants Bank's bank in the middle, their problem loan is just slightly about 2%, but their provision coverage is up to 5%. So they're more than covered. But overall, what I would look at in terms of non-performing loans, because this is going to be a very tough year for bank analysts. You're not going to be able to see the correct non-performing loan numbers because of the loan forbearances, because of the policy support rate. But what I would look at, what they cannot lie about, number one is the overdue loans. You look at their 90-day overdue loans. The other thing is you look at the special mention loan migration. So what they booked as special mention loan at the end of last year, how much of that has actually gone into the non-performing loan category? That's one thing that I would look very closely at. And again, it's similar to India and a lot of other emerging Asian economies. We've got to support the small to medium enterprises because in China they account for about 60% of GDP, but the financing that they're getting is a lot less than that. So with the current environment, they're going to continue to suffer, I think. How big of a problem is that? If you look at the chart at the bottom left, so what they call the micro loans. So think about them as companies with about 10 million RMB in revenues. So it's about a quarter of the loan book of the whole sector, right? And within that, what they call inclusive finance. So companies that are even smaller than that, it's about a third of that. So that's sort of the scale of the problem. But then in terms of the amount, absolute amounts, right? So the larger state-owned banks are going to take the majority of the problems. But then as a percentage of the loan book, it's not that big of a problem. I think the stress point, though, is with perhaps the non-listed, smaller rural commercial banks. So we're going to see a pickup in NPLs in that particular sector. And although individually they may not be important to the system, collectively they are as big as the larger joint stock banks. So finally, with what's been happening with the policy support, are regulatory reforms ongoing or are they going to be stalled, right? So the short answer is I think the financial reforms are still going to happen. And here we point to a very specific problems, right? With the wealth management products. We think the reforms are ongoing, but like I said, the deadline is going to be postponed, right? So if you look at the wealth management products for the whole sector, as a percentage of the deposit base, it's come down to about 12% maybe. It's going to go down further, I think, in the next 2 years to about the 10% level. So it may be worrying for specific banks, but for the sector as a whole, I think the risks are still within control, especially if you look at chart 4 in this slide, right? So what they call the non-standard credit, which basically means credit assets that have no liquidity or market price, it's now about 17%. It's a problem, but I think it's a problem that we're going to grow out of in the next 24 months. So that concludes my presentation. Thank you.
Thank you very much, Stanley, for a great presentation. So we now I hope that attendees have an idea of the what is happening in the banking sector and what we expect. Also, we hope that the policymakers really do their thing and support the banking sector. So as
Yeah, we can only hope for that, right?
yeah. Because it is one of the key aspects which is very important, and of course the industry support which is also required from banking side. And let's see how the if lending goes down and the interbanking rates remain on the same level. So yeah, it is a very brief and like very clear picture which you have given. So thank you very much. Thank you very much. So if we have any questions for Stanley, you can send it to us. We will mail it to Stanley and he'll be able to reply on them.
Thank you.
Yeah, thank you very much, Stanley. Thank you.
All right, stay safe.
Thank you. Hi, everyone. So now I will make a brief after these two wonderful presentations. I will make a presentation on our website. So now you have an understanding on what to look at, what are the key parameters when you invest in different industries, or now you have an understanding. So I would like to show you the platform. I'll share my screen now. So the platform is just a second. I'll share my screen. Okay, so now you have an understanding of the platform, how everything, I mean, of the ideas which speakers have already given. So we have a platform which will help you search on different parameters. So there are two parts. One is to search, analyze, then you can also track your investments. So this is how our platform looks like. So this is a brief overview landing page. We have different methods of getting the data from the system. First thing is, of course, the web page that I have opened. So website through which you can get the information. Then we have mobile app, Excel add-in. So Excel add-in helps you work directly into Excel using the formulas which we have embedded. It just installs a tool and you can use different formulas and retrieve the data. Then also we do provide API feeds. So that is, we send bulk data to different banks and financial institutions who use them in their internal system for their analysis and give a brief, you can say, useful interface which they already have internally and present our data. So the first tool, which is heart of the CBONS platform, that is the quick search tool. So this is very important tool because you can just type in. So as we were discussing about India and China, we can just type in India and you will see the different results. So right now we have more than 1,000 Indian bonds. Then you can also see indices, stocks. So the quick search tool, what it does is it browses through all the information on our platform and gives you result in bond sector, stock sector, as well as indices. So let's talk about the bond sector. So I just wanted to show you some bond of, let's say, Adani Port. This is Indian issuer, and then you can just type in USD. So you will get a list of all the USD bonds of this particular issuer. You just click on the name of the bond and it will open the bond page. So here we have a bond page. I will also definitely go through all the details which we have here of the bond page. So we have different sections and everything. So I will definitely go through each section and explain how exactly it works in couple of minutes. Another important tool is the bond search tool. So this tool has more than 100 different parameters which can be used to search data on specific needs which you have. Let's say you are interested in, as we were discussing, let's say we are interested in Asian market. So you select Asia. Then in industry, as we were discussing, Stanley, about banking sector. So let's select bank. And you want to know all the bonds in US dollars. So you just type USD. And we can select yield, let's say high yield bond more than 5%. Of course, you can put duration, placement, maturity. Then we have ratings from different rating agencies. So let's say we can select the ratings from any two of these, like Moody's, S&P, Fitch, any two of these more by investment grade. Let's say BBB to AAA. And we do have different classifications. So because some are interested only in sukuks, or they don't invest in convertible, so you can include and exclude all these parameters based on requirement. In issue information, you can put any special purpose vehicle name if there is any created by the issuers, or start, put date, or if suppose you want interested in specific volume, you can put all these parameters here. So right now what I have done is, here you will see all the parameters which you have selected. So I have selected region as Asia, banking sector, all the outstanding bonds in USD, and yield more than 5%. And plus I have selected ratings from any two of the Moody's, S&P, and Fitch rating agencies as investment grade. So you just click on search. So let's do that. And what it does, it goes through more than 350,000. So it is a very fast search engine. It has now went through more than 350,000 bonds which we have from more than 180 different countries who issue bond. And it has given a result. So right now you can see we have 5 bonds which satisfy the given parameters. So here you will have basic information in results. That is, of course, the country, issuer, the currency which we have already selected, what is the coupon rate of these bonds, amount, then other information like rating. So you see here rating from different agencies, then of the issuer as well as for this particular issue, maturity date. These are all then call option which we have, and you can see here what is the indicative price and what is the last updated price. So these are yesterday's closing date. So rates. So you can see CBONS estimation. So CBONS estimation is our own methodology to calculate prices and yield. So it basically, you can say, is a weighted average of the prices which we get from different market participants. Now this is the result. You can save it and export it to Excel, so you can work with Excel. Then another thing is you can save this query so that you don't have to select different parameters all the time. Let's say someone is interested only in the these specific bonds and he wants to search them regularly. So you can just put in and save, let's say, Asia high yield. Save it. Now you will see that it will say query has been saved. So you can see on the top we have different queries. I have different queries saved. You can just click on Asia high yield and it will give you the same results. So this is very important. So whatever results which match these parameters, you will see them here. to check. So let's say you want to check information on this particular bond, you just click on it. It will take you to the bond page. So this is our bond page. Now you will have it, if it is secured, you will have it here written here, senior secured. Now this bond is junior subordinated and perpetual bond. So you have all this information. Again, we have basic information of the bond, that is issue rating, then what is the placement date, what is the put call option. Again, you will see here price and yield as per Seaborn's estimation. We scroll down, we always have we have a largest database of the documentation that includes prospectus, final terms, etc. We have trading chart. So this is the price chart. You can check the yield chart. You can change the period. So you can we have embedded 3 month, 1 year, 3 year period. You can always change that by selecting period and putting it from 2. If you want to know get the historical prices in a table format, you have to just click here and you will get all the prices. This shows you the prices. Now you can see that there is a limit to the field, but it is not a constraint. What we can do is you can select solely. If you want to say this bond was issued in we check that in 2015. So what we can do is you can select from Jan 2015 and click on export. So you will get all the historical prices exported to the Excel sheet. So which is very important that you get, and then you can use it for the other calculations as well. Now this section has stock exchanges and OTC codes. So here you can see codes from different market participants as well as from the stock exchanges. You can see we have intraday code from Frankfurt Stock Exchange here. So from German stock exchanges, Moscow Stock Exchange, we have intraday codes. So it is with 15-20 minutes delay, but it gives you a brief idea of the pricing and yield, everything, all the information. Then again, we have all the issue information, cash flow. So you will have what are the parameters of the cash flow. So this has coupon frequency 2 times a year. Then we, as per date, you can see here the coupon payment period, dates when the coupon are scheduled, what are, if there are any early redemption terms, you will see them here. Then again, other information about placement. So this section is very important because you have ratings from different rating agencies again in detail. So you have the date on which this rating has been updated. We understand how important it is for our users that you have very quick access. So what we have done is we have put covenants in place. So what these do is you will get a snapshot of what are the covenants which are there in the prospectus itself, as well as we have linked it to directly to the paragraphs inside the prospectuses. So you want to know the paragraph with events of default, you just click on here and it will open the prospectus. So you don't have to scroll 300-400 pages of prospectus. It will just take you to that specific paragraph in the prospectus. Then we do have bond classifications, IFRS reports. So we do have IFRS reports. We have recently started entering the holders information, which was a very important thing, requirement from our users, that they wanted to know like which are the ETFs which hold these bonds. So we have started putting there with the date on which it is updated. Also the related or other bonds of this particular issuer are shown here. Then If we scroll up, you can see we have different tools here. So if you right now, let's say the price is, let me check. So I want to calculate the price. So it will automatically give you the C-bonds estimation price. So I want to know what would be the, so if I have a quote for 203, let's say, so what would be the yield to maturity, accredited interest. So you have to just put the face value, and it will show you all the information like yield to put, because this is a perpetual bond, you have yield to put, accredited interest, all the other parameters. So we have a glossary for all these parameters, which you will be able to see. Then this, what we have went through how to look in for a bond. Let's say you have some bonds which are in your portfolio, or there are some bonds which you want to track and get updates. So the best tool is watchlist. So when you are, there are different methods to add issues to the watch list. One of the methods is when you are on the bond page, you have to click add to watch list. You can select, so it will give you an option to select different trading floors. You can select multiple trading floors, but we recommend C-bonds estimation. As I said, it gives you a weighted average of the prices which we have from all these sources. So it will give you an average price. So we save it, or if you want, of course, you can again add and remove the bond from watch list here. So I'll add another, that is Hong Kong Stock Exchange. So when I save it, let's go to the watch list tool. So it is here, watch list. So now as we are on the watch list tool, you will see I already have different bonds added to my watch list. So just now we added one bond, that is Bank of East Asia. So you can see we have two different parameters which have been added. So here C-bonds estimation. Then we again scroll on the right hand side. So the very important tool again here option is to keep track of bonds. So you just click on the bell icon, select price or yield. So you want to track, let's say I want to track when the price goes below 98. So let's say when it goes below 98, and I save it. So whenever the price goes below 98% of the face value, I will receive a notifications in the mail, as well as there are some notifications which are stored here for 30 days. So even if you miss the mail and you logged in, you can always check the notifications which you have missed and everything here. So these are all the notifications which I have received in mail, plus they are here. So now it is very easy to keep track of the bonds. We also do have mobile app, and it is all synchronized with the platform. So in the mobile app also you can add, remove the bonds to watch list. It will show you the price change. So lots of investors, then investment managers, banks which use our platform, what they do is in the morning they open the mobile app and go to the watch list. So they already have a list of bonds which they are tracking of their clients, or if it is a private investor, of his investments, or if he is planning to invest in, and just scrolls and gets an idea what is happening in the market, where what is the trend for these particular bonds, where it is moving. So this is one of the very important tool. Then we do store information on stocks. So this is something which we have started recently. This was because we wanted that those who invest in bonds, they generally have a investment in stocks as well, and and we wanted to make a platform where both the information is available. We right now have information from 51 different stock exchanges, which we are now improving. So every month there are a lot new stock exchanges, then stocks are being added. So as you can see, based on different parameters, you can again search for different stocks. We will be adding stocks to the watch list tool as well. So it is, you can say, under development. Then we have indices. So this is one of the largest database of indices as well. We do have indices including like coronavirus and all for different countries. So now it is loading. Let me go back. Okay, so now here we have indices. It works the same. You can type here any index, or let's say I want to know the CDS of a particular country, let's say India. So what we can do is, you can of course type here CDS India. So it will give you all the CDS here, as well as you can select, just say country India, like different parameters. So I want to know all the indices which are there for India, let's say. So just click on get values. So these are all the indices which are there, including like CDS, derivative market and all. So just click on that particular index. It will open a page wherein you will see all the CDS graph. For you can of course change it to 1 year, 5 year, 10 year. So we also provide, so the source of this data, you can see it in the table form, export it to Excel. Again, as we check the code, you can put the different date range and export it to Excel as well. Then again, the tool which I mentioned, that is Excel add-in. So you have to just download the Excel add-in tool, use different formulas which we have in place, trading floor. You can using that you can download all the information on bonds which are there in your watch list, get financial reports, if the issue information. So you have to just put the ISIN and you will get all this information as well. So this, I would like to give you an individual presentation. So you can contact me for the presentation. I will be more than happy to plan an individual session with you and show you all the formulas, how it works. Of course, I'll go through all the tools which we have. Then API. So there are some companies who are interested in the API feeds, so which can be done. So we have different parameters here as well. So you just use, we have our own forms and everything. We have a separate team which handles API. So if you are interested in API as well, please feel free to contact me, and we'll arrange it for you. And also I wanted to mention is we'll be having some special prizes for all the participants of this seminar. So feel free to contact me. I hope this session was very useful to you, and you got all the information from different speakers and everyone. For all the questions you have on the platform, I would be happy to answer now. So if you have any questions, please feel free to share on my email ID, or you can type them now. And thank you very much. Thank you. Yes, so we have a question. Yes, this session is being recorded, and we will have everything, all the information on our YouTube channel tomorrow. So you will get all the information. So I guess there are some participants who joined in late. Yes, this session is being recorded and we will have it in on our YouTube channel. Yes. Okay, thank you everyone. So feel free to contact me for a trial access, or if you have any questions regarding platform. Thank you very much. Have a nice day. Thank you.